Hello everyone and welcome back to the sessions on strategic financial management. Friends, in this class of CA Final SFM, we are continuing with the topic share valuation, and this is the fifth and last lecture on share valuation. Friends, in today's class, we are first going to start with the concept of right issue. How the right issue by any company would affect the value of its shares. How would you determine the value of rights? As an investor or an equity shareholder, if you obtain rights, what can you do with that right? What would happen if you just don't take any action? And what would happen if you exercise that right or sell those rights? All these possibilities we are going to talk about first, and then we will also cover up some miscellaneous types of questions in this session itself. So friends, let's straight away get started with the concept of right issue and right valuation. So your focus on screen, let's begin with question number 38. Let us read this question. Number of equity shares on 1/4/2018 given as 3 lakh shares. On 1/6/2018, the company announced a right issue, that is 2 right shares for every 3 shares already held. Exercise price for right shares is rupees 28 per right share. Last date to exercise the right was 30th June 2018. Fair value of each equity share on 30th June 2018 immediately prior to right issue was rupees 48 per share. You are required to determine the theoretical ex-right price per share. Now friends, in this question, you are just required to find out theoretical ex-right price per share. Let us first finish off the calculation and then we go into the logical background of the same. So let us see how to present the solution. In the solution, you would write up a formula for theoretical ex-right price per share. The formula will be P equals to M into N plus S into R divided by N plus R. So write up the definition of each of these variables. P stands for theoretical post-right price per share. M is the market price per share prior to right issue. N is the number of existing shares. S is the subscription price or exercise price. And R is the number of right shares offered. So friends, what we are going to do, we are going to first substitute these values and then work out the post-right price per share, which is called theoretical ex-right price per share. So let us do one thing. You see, M stands for the market price per share prior to right issue, and that in the question was given as 48. Now N is the existing number of shares that is prior to right issue, and that is 3 lakh shares. S stands for the subscription price or exercise price, and R stands for the number of right shares offered. So when you substitute these values, it will be 48 into 3 lakhs plus 28 into 2 lakhs divided by 3 lakhs plus 2 lakhs. In the numerator, you would get 1 crore 44 lakhs plus 56 lakhs divided by 5 lakh shares, and finally what you get is rupees 40. Friends, do one thing, write up this whole thing and then I will give you necessary explanation. Alright friends, you would have finished writing this whole thing. Now there is absolutely no need of putting pressure on your minds to remember these kind of formulas if you can use simple common sense and understand the logic behind this. Very simple, and I believe some of you might already be aware of this. You might have learned this even at intermediate levels. Now see, there were 3 lakh shares prior to right issue, and worth of each share was rupees 48. So the total worth of the company, the overall worth of the company, or you can say overall equity value of the company, was 3 lakh shares into rupees 48. That gives you 1 crore 44 lakhs. Now you are issuing new shares in the form of right shares definitely, but you are issuing new shares, 2 lakh shares, and the price at which you are issuing these new shares, it is rupees 28. So what happens? You will be having additional inflow of funds on account of equity issue, and that will be part of your shareholders funds. That will be 2 lakh shares multiplied by rupees 28. That gives you a value of 56 lakhs. So 1 crore 44 lakhs was the net worth prior to right issue, and after the right issue 56 lakhs of worth gets added to this existing equity. The total net worth will be 1 crore 44 lakhs and 56 lakhs aggregated. What you get is 2 crores. And now the total number of shares earlier were 3 lakh shares, and the new shares issued on account of right issue were 2 lakh shares. So in total there will be 5 lakh shares after the right issue. Finally, you see the total net worth of 2 crores getting divided by 5 lakh equity shares. The average value per share, what you get after exercising rights, will be 2 crores divided by 5 lakh shares, and that will be rupees 40 per share. And that rupees 40 we call as theoretical ex-right price or theoretical post-right price per share. The simple reason why we call that value as theoretical, because after rights have been exercised, there will be many factors that can influence the value of the share or the price of the share in the stock market. But we are computing theoretical ex-right price, means we are giving purely the effect of right issue only, and that is why this value is a theoretical value. So friends, do one thing. In coming questions, this calculation will again be required, but my sincere advice to you, you should logically always make this calculation. So what we do is, in the next question, we will be taking up not just this calculation, but as an effect, how shareholders' wealth gets affected by taking or not taking a particular type of action with respect to the rights. So let us do one thing. Let us move ahead and take up the next question, that is question number 39. Let us read this question. The share of Galaxy Limited of a face value rupees 10 is being quoted at rupees 24. The company has a plan to make a right issue of 1 equity share for every 4 shares currently held at a premium of 40% per share. You are required to determine the minimum price that can be expected of share after the issue. Indirectly they are asking you the theoretical ex-right price per share. Second thing, they are asking you calculate the theoretical value of the rights alone. And third thing, show the effect of right issue on the wealth of a shareholder who has 1500 shares if, 2 conditions, he sells the entire rights, and second condition says he ignores the rights. So friends, out of the 3 requirements given in the question, the first part you know very well. Let us first calculate that, and then we deal with the other 2 things. So theoretical ex-right price, which can be also called as expected minimum price. As I have told you the formula earlier, we have understood this. You should define all the variables without fail, and then you should put up the value of these variables in the formula and work out the theoretical price or the minimum expected price. and that would come to rupees 22 per share. So do one thing, write up this whole calculation and then we shall move ahead. Alright friends, you would have finished writing this whole thing. Now the question has asked you in the second part, what would be the theoretical value of the rights alone. Now look into one thing. What is the price at which the right shares were issued? Right shares were offered at a price of 14. How we got 14? Face value plus 40% premium. That is 10 plus 40% would give you this 14. Correct? Now this is rupees 14 at which the shares have been offered. However, after the exercise of this right, the worth of that share will become rupees 22. Correct? So the worth of the share becomes 22 after exercising the right. That means when you buy one share, you pay rupees 14, but the value of that share would become rupees 22. So what would happen? You compare 14 and 22. That difference of rupees 8 will be the value of the right. That is one way to determine that. Another way could be you compare the prior value of rupees 24 and the post value, that is rupees 22. Prior value 24, post value 22. That difference is rupees 2 per share, that multiplied by old number of shares that were 4. So 2 into 4 would also give you 8. Either way, you can calculate the theoretical value of rights alone. So let us do one thing. Let us see how to present that part of the answer as well. Theoretical value of rights, it will be post right price minus subscription price, that is 22 minus 14, and that gives you 8, or M minus P into N. As per the variables, M is 24, P is 22 and N is 4. So finally that also gives you 8. Now friends, in the third part of the question is asking you that the shareholder, one of the investor, is holding 1500 shares. First of all, for every 4 shares held, the shareholder is offered one right share. So for 1500 shares, how many right shares will be offered? Let us first work out that. So effect of right issue on the net wealth of the shareholder. So number of right shares offered will be 1500 existing shares into 1 by 4, and that will be 375 shares. So friends, do one thing, write up this much and then we shall move ahead. Alright friends, you would have finished writing this whole thing. Let us move ahead and see the effect. So, if the shareholder sells the entire rights, what will happen? Value of 1500 shares before right issue was 1500 into 24, that is rupees 36,000. Value of 1500 shares after right issue will be 1500 into 22, and that will be rupees 33,000, and realization on sale of rights will be 375 right shares multiplied by rupees 8. Don't forget that rupees 8 is the value of right alone. For 1500 shares originally held, the shareholder will be having 375 right shares in his hand. That means he has rights for buying 375 shares. If he is selling that right, he is getting rupees 8 per right, that is 8 multiplied by 375. The total cash realization will be rupees 3,000. And finally, the total wealth after right issue, 33,000 plus 3,000, that will be 36,000. So the net effect on the wealth will be zero, nil, because whatever was the wealth earlier, the same is the wealth even after the right issue. So there is no change in the value of the shareholder's wealth before and after right issue if he is selling his entire rights. So do one thing, write up this part of the solution and then we shall move ahead. Alright friends, you would have finished writing this whole thing. Let us move ahead and deal with the next part, that is B part. If the shareholder ignores the rights, now what will happen in this case? The value of 1500 shares before right issue would anyway remain the same, correct? That will be 1500 into 24, that is 36,000. And now what will happen? The value of 1500 shares after right issue is going to drop to rupees 33,000, the way it was earlier. Now what is the realization on sale of rights? This time the realization on sale of rights is nil, because the shareholder has ignored that right. He is having the total wealth in hand after right issue as just 33,000. This time the resulting loss to the shareholder is 36,000 minus 33,000, that is rupees 3,000. So friends, take note of this part as well, and that will be end of the solution. Alright friends, you would have finished writing this whole thing. Let us move ahead and take up the next question, that is question number 40. Let us read this question. Consider the following balance sheet of Target Limited on 31/3/2011. Equity share capital rupees 20 lakhs, 8% preference share capital, that is shares of rupees 100 each, redeemable at rupees 110, and that has nominal value of 10 lakhs. Reserves and surplus 10 lakhs and current liabilities 20 lakhs. Now you have fixed assets, current assets and preliminary expenses, and below the balance sheet it is given preference dividend is already paid off. The liabilities include dividend payable of 15% on equity shares. The dividend payout of the company is 60%. The company has indicated growth in dividends at a consistent rate of 6% per annum. The proper valuation of fixed asset is 20% more than the book value. You are required to determine the intrinsic value of each equity share as cum dividend and ex dividend. Also determine the following, that is earnings per share of the company for year ended 31/3/2011 and market price of each equity share if the market price is 10% above the intrinsic value ex dividend, and the price earning ratio. So friends, if you can recall, in the first lecture of share valuation, we have talked about asset based valuation, right? So exactly the same thing is required over here. We are required to arrive at the intrinsic value of each equity share, and that begins with the realizable value or the proper value of fixed assets being 20% more than their existing book values, current assets taken as it is, and the total value of assets come to 62 lakhs. Liabilities including the dividend payable is 20 lakhs. Net assets over and above the liabilities, which includes dividend payable, is 42 lakhs. Now what happens? The dividend component is included in this liability, so whatever be the net value of this asset, it is excluding the dividend component. Now from this we would remove the redeemable value of the preference shares, and what we get is net assets belonging to equity shareholders. So do one thing friends, first write up this and then we shall move ahead. Alright friends, you would have finished writing this whole thing. Let us move ahead. And now what we do is we work out the intrinsic value of equity shares, and that will be X dividend. Now it is obvious that this initial value of 31 lakhs, which represents net assets belonging to equity shareholders, this does not include the component of dividend, and that is why this value what you got is titled as X dividend. Now dividend per equity share was rupees 15, and intrinsic value cum dividend will be X dividend value plus dividend, and that will be 170. So we can conclude that X dividend value of equity share is 155 and cum dividend value of that equity share is 170. Note down this quickly and then we shall move ahead. Alright friends, you would have finished writing this as well. Let us move ahead and now determine the earnings per share, because dividend per share was given as rupees 15 and dividend payout ratio is given as 60%. So earnings per share will be 15 divided by 60% and that will be rupees 25. Now the market price of each equity share is going to be 10% more than the intrinsic value x dividend. So market price per share will be 170.50. Now we know the market price per share, we know the earnings per share, we can easily determine the price earning ratio, and that will be market price per share divided by earnings per share, and that will be 170.5 divided by 25, and that will be 6.82 times. So friends, do one thing, write up these calculations as well, and that will be end of the solution. Alright friends, you would have finished writing this whole thing. Let us move ahead and take up the next question, that is question number 41. See what is given over here. Capital structure of Sun Limited as at 31/3/2003 was as under. Equity share capital rupees 80 lakhs, 8% preference share capital rupees 40 lakhs, 12% debentures rupees 64 lakhs and reserves rupees 32 lakhs. Sun Limited earns a profit of rupees 32 lakhs annually on an average before deduction of income tax, which works out to 35%, and interest on debentures. Normal return on equity shares of companies similarly placed is 9.6%, provided profit after tax covers fixed interest and fixed dividend at least 3 times. Capital gearing ratio is 0.75. Yield on share is calculated at 50% of profits distributed and 5% on undistributed profits. Further given, in case of any differences between Sun Limited and industry average, make the following adjustments. Risk premium of 1 time of difference in fixed interest and fixed dividend coverage between Sun Limited and industry average. Risk premium of 2 times of difference in capital gearing ratio between Sun Limited and industry average. Sun Limited has been regularly paying equity dividend of 8%. Compute the value per equity share of the company. So friends, you can see one thing. In this question, lot of ratios involved, and you are going to compare ratios of your company with those established in the industry, that is for the companies which are involved in similar business. So let us see how to go ahead with the solution. In the solution, you are first going to compute the profit after tax, and now for that the profit before interest and tax is given as rupees 32 lakhs. Debenture interest will be rupees 7,68,000. Profit before tax will be 24,32,000. Tax will be 35%. So profit after tax is 15,80,800. From that you subtract the preference dividend, and that is 3,20,000, and equity dividend is 6,40,000. So what you get is retained earnings or undistributed profit. We have arrived at this undistributed profit because the base of the share valuation as required in the question is to give some weightage to the distributed profits and some weightage to the undistributed profits or retained earnings. So friends, before we move ahead, please take note of all these calculations. Alright friends, you would have finished writing this whole thing. Let us move ahead and compute those two ratios which the question has required. That is, first of all, the interest and fixed dividend coverage ratio. You know very well how this ratio is determined. It is the profit after tax plus debenture interest divided by debenture interest plus preference dividend. I believe that you know the logic behind computing this ratio. For payment of preference dividend, it is the profit after tax that is available as income in hand. Because you are talking about commitment to pay both of these components, to profit after tax you will add back debenture interest as available earnings in hand to distribute these two amounts, and that is what we call as interest and dividend coverage ratio. In this case, it is 23,48,800 divided by 10,88,000, and that comes to 2.16 times. Write this quickly and then we move ahead. Alright friends, after writing this, let us move to the next ratio, that is capital gearing ratio. You know how to calculate capital gearing ratio, right? Capital gearing ratio will be all the fixed income bearing funds divided by equity shareholders funds. In simple words, it is preference share capital plus debentures divided by equity share capital plus reserves, and that would give you 40 lakhs plus 64 lakhs divided by 80 lakhs plus 32 lakhs, and that is 1 crore 4 lakhs divided by 1 crore 12 lakhs, and that is 0.93. So once you have computed these ratios, you are then going to compare these with the industry averages and then make the risk adjustments accordingly. So do one thing, first write up this calculation and then we shall move ahead. Alright friends, you would have finished writing this whole thing. Now let us move ahead and compute the yield on equity shares. Now they have given specific instructions how to compute that yield. Yield on equity shares is calculated at 50% of profits distributed and 5% on undistributed profits. So simply whatever profits you have distributed, take 50% of that. Now take care of one thing, you should take only that part of the profit which is distributed to equity, okay, because you are computing yield on equity. Don't take the preference dividend into picture over here. And then 5% on undistributed profit, and the aggregate of that will be identified as yield on equity shares. Now this yield on equity shares will be divided by equity share capital to get the result in percentage, and that comes to 4.388%, or you may also write as 4.39%. So friends, write up these calculations quickly and then we shall move ahead. Alright friends, you would have finished writing this as well. Now time for us to compute the expected yield, because the expected yield is based on those two ratios compared with the industry average, and where the risk adjustment would be required. We would say the interest and fixed dividend coverage of Sun Limited is 2.16 times, but the industry average is 3 times. First of all, you should know one thing very well. Coverage ratio, the higher it is, the better, correct? So it is 2.16. What is the meaning of 2.16? For every 1 rupee of the interest and dividend is to be paid, the company has income of 2.16 in hands, whereas the industry average is more. So this ratio lower than the industry average, it is not good. Therefore the risk premium is added to Sun Limited at one time for every 1% of difference. So the risk premium to be added will be 0.84%. Now regarding capital gearing ratio, you should not forget that the numerator includes the outsiders funds, that is shareholders which are preference shareholders, and the debenture holders. these are considered as outside contributories from the viewpoint of equity shareholders. Their funds are divided by the shareholders' funds. So, with respect to capital gearing ratio, a very high ratio is not appropriate. So, here our company has the capital gearing ratio of 0.93, but the industry average is lower. Means our case is little more risky over here. And as per the requirement of the question, 2 times of that difference will be adjusted in terms of risk. So that difference is 0.18 over here, and to that difference you are multiplying 2 times, and finally what you get is 0.36% towards risk adjustment. So we can conclude one thing, 0.36% will be adjusted towards the risk arising because of capital gearing ratio, and 0.84% will be adjusted to the risk arising because of fixed dividend and coverage ratio. So do one thing, write up this content as well, and then we shall move ahead. Alright friends, you would have finished writing all these. Let us move ahead and now to the last part of the question, and we have already arrived at a lot of information about determining the value of the share by now. So what we do is, we first find out the rate of return. So the normal return expected in the industry is 9.6%. Our case is little more risky, so we would add risk premium for those two ratios, and we have already discussed about this. So the expected rate of return in our company's case will be 10.8%. Now value of equity shares will be actual yield divided by expected yield multiplied by paid up value of the share, and that comes to 4.39 divided by 10.80 into 100, and that is 40.65. So the value of each equity share will be rupees 40.65. Let me explain you this last part once again. See, the simple logic over here is the paid up value of share is 100 and your actual yield is only 4.39. We have worked it out, right? So 4.39. So on 100 your actual yield is only 4.39. So if you calculate by percentage, 100 into 4.39 will be 4.39. Now 4.39 is the rate of return, as well as we can say 4.39 is the return on the face value of the share, correct? So if 4.39 is the earnings and 10.8% is the expected rate of return, the capitalized value of this earning will be 40.65, which is concluded as the value of the equity share. So friends, please take note of this as well, and that will be end of the solution. Alright friends, you would have finished writing this whole thing. As I have mentioned that this is the last lecture on share valuation. So let us declare this as not only end of part 5 but even end of this topic, share valuation. Thank you so much for attending this class.